$12 billion in shareholder value vaporized in 3099 days. $5 billion of that vanished in 45 minutes. On April 2nd, 2020, at precisely 9:31 a.m. Eastern Time, Luckin Coffee's stock price began a free fall so violent that circuit breakers tripped, trading halted, and financial analysts watching their Bloomberg terminals thought their screens had glitched. They hadn't. The fastest company in history to go from founding to Nasdaq listing had just confessed to fabricating $310 million in sales. 40% of everything they claimed to sell in 2019 did not exist. The coffee was real. The customers were ghosts. While the ticker froze in New York, executives in Luckin's Xiamen headquarters were shredding documents and wiping servers. 8,000 miles away, auditors at Ernst & Young sat in stunned silence, staring at a table covered in fake vouchers they'd traced back to shell companies owned by the CEO's relatives. And somewhere in a nondescript office building in Beijing, a team of analysts was still fast-forwarding through surveillance footage, the chipmunk speed audio of customers ordering coffee playing through cheap headphones. They had spent months counting cups. They had recorded over 11,000 hours of video. They had collected nearly 26,000 receipts from trash cans outside Luckin stores. They were the ones who caught the lie. This matters because Luckin wasn't just another corporate scandal. It was a stress test for the entire architecture of international finance. A Chinese company had used American capital markets to fund a fraud so brazen it made Enron look subtle. The SEC was humiliated. Nasdaq was embarrassed, and the ripple effects would reshape how Wall Street treats every Chinese company seeking American investment. The Holding Foreign Companies Accountable Act, which now threatens to delist hundreds of Chinese firms from U.S. exchanges, exists in large part because of what happened inside Luckin Coffee. But here's the part that should keep you watching. The company didn't die. The founders didn't go to prison. And right now, as you're hearing this, Luckin Coffee has more stores in China than Starbucks. The people who orchestrated the fraud are running a new coffee chain. The scheme worked, and nobody stopped them. Charles Liu built his empire on a simple insight. In China, the fastest player wins. Not the best, not the smartest, the fastest. He understood that in a market of 1.4 billion consumers, the company that achieves scale first gets to write the rules. Everyone else fights for scraps. His first experiment was Car Inc., a car rental company he founded in 2007. The playbook was brutal. Raise enormous amounts of money. Burn through it faster than competitors can respond. Subsidize prices until rivals go bankrupt. Inflate your metrics to attract more investment. IPO before anyone checks the math. Exit before the crash. Car Inc. went public on the Hong Kong Stock Exchange in 2014. Charles Liu walked away with hundreds of millions of dollars. The company's stock would eventually collapse, but by then he had already moved on to his next project. October 2017, Beijing. A small storefront opens in a business district. The logo features a leaping deer. The name is Luckin Coffee. The mission statement, repeated constantly in internal meetings and investor pitches, is explicitly nationalist: defeat the American invader. Starbucks had been in China for nearly 2 decades. They had thousands of stores. They had become synonymous with premium coffee. Charles Liu looked at their market dominance and saw vulnerability. Starbucks charged premium prices. They focused on the in-store experience. Their expansion was methodical, careful, profitable. Luckin would be the opposite. Small pickup kiosks instead of lounges, mobile ordering instead of baristas, and prices so low that buying a Luckin coffee was practically free. The subsidies were insane. A latte that cost Luckin 18 yuan to produce was sold for 6, sometimes less. Promotional coupons brought prices down to the equivalent of 50 cents. Customers couldn't believe their luck. Why would anyone pay Starbucks prices when Luckin was essentially giving coffee away? The answer, of course, was that Luckin couldn't sustain this. No company can. The unit economics were catastrophic. They claimed a store-level profit margin of 12.5%. The reality was a loss of 28%. Every single cup of coffee sold cost them money. But Charles Liu didn't care about profit. He cared about growth. He cared about the story he could tell investors. And the story was spectacular. Luckin opened its first store in October 2017. By December 2018, they had 2,000 stores. By the time of their IPO in May 2019, they had 4,000. They were adding new locations faster than Starbucks had ever dreamed possible. The Chinese press called it a miracle. American venture capitalists poured money into the company. BlackRock invested. Singapore's sovereign wealth fund invested. The narrative was irresistible. A scrappy Chinese startup was taking on the American coffee giant and winning. May 17, 2019. Nasdaq. The ticker symbol LK begins trading. Luckin raises $561 million in its initial public offering. The company is valued at $4 billion. It has existed for 18 months. No company in history has gone from founding to public listing faster. Charles Liu stands on the trading floor, watching the numbers climb. He has done it again. The blitzscale playbook works, except the numbers climbing on that trading floor screen were as fake as the ones in Luckin's financial statements. The fraud was elegant in its simplicity. It started with coupons. Luckin's entire business model depended on deep discounts to attract customers. Promotional vouchers were everywhere. Buy 10 cups, get 5 free. Download the app, get a free latte. Refer a friend, get credit for both of you. In theory, this was standard customer acquisition spending. In practice, it was the perfect hiding place for fabricated revenue. Here's how it worked. Luckin created shell companies. These shell companies were controlled by people connected to Charles Liu and his inner circle. The shell companies would purchase enormous quantities of vouchers from Luckin in bulk. Hundreds of thousands of vouchers at a time. On Luckin's books, this looked like revenue. A corporate client had just bought 200,000 vouchers. That's real money coming in, except the money came from Luckin itself. They would invest in a shell company. The shell company would buy vouchers, and the purchase would appear as sales. The coffee never left the store, the money never left the family. But on paper, Luckin was a rocket ship. The voucher scheme was the foundation, but Luckin's engineers built something even more clever on top of it. They rigged the order numbering system. In a normal coffee shop, order numbers are sequential. You get order 101, the next customer gets 102, then 103. You can glance at the current number and estimate how busy the store has been. Luckin's system was programmed to jump. You might get order 101, the next customer gets 106, then 114, then 127. To anyone watching, the store looked packed. The numbers suggested a constant stream of customers. Investors visiting stores would see order 589 and think business was booming. The reality was that order 587 and 588 had never existed. The machine was hallucinating customers. They also inflated their advertising expenses. This might seem counterintuitive. Why would a company want to look like it's spending more on marketing? Because expenses can hide fraud. Luckin would claim to pay a vendor 10 million yuan for advertising services. The vendor would actually receive 2 million. The remaining 8 million would circle back to Luckin through a maze of shell companies, eventually appearing as revenue from voucher sales or corporate partnerships. The advertising never ran. The money just moved in circles, each rotation inflating the company's apparent size. By the third quarter of 2019, nearly 40% of Luckin's reported sales were completely fabricated. They were a real company selling real coffee to real customers. But for every 10 cups they claimed to sell, 4 were phantoms. The people who caught them weren't regulators. They weren't journalists. They weren't whistleblowers with a conscience. They were short sellers trying to make money. In late 2019, a hedge fund called Snow Lake Capital began asking uncomfortable questions. Snow Lake was based in Hong Kong, run by people who understood Chinese business culture intimately. They knew the blitzscale playbook. They knew Charles Liu's history, and they knew that Luckin's numbers were too perfect. The growth was too smooth. The margins were improving too quickly. Something felt manufactured, but feeling isn't evidence. To prove fraud, you need data, and Luckin's data was locked inside their own systems. Chinese companies listing on American exchanges face minimal scrutiny from U.S. regulators. The SEC can't send investigators to Beijing. American auditors rely on information provided by the company itself. The whole system depends on trust. Snow Lake decided to verify. What they built was the largest private corporate investigation in history. They recruited 92 full-time investigators. They hired 1,418 part-time staff across 45 Chinese cities. They deployed teams to over 600 Luckin locations, and they started counting. The methodology was brilliantly low-tech. Investigators would enter a Luckin store in the morning, buy a small coffee, and sit down. They would stay for 10, 12, sometimes 14 hours. They filmed everything: the counter, the door, the register. They recorded every customer who walked in and every cup that walked out. When the store closed, They would wait outside and photograph the trash, digging through garbage bags to collect receipts that customers had thrown away. They did this for months. The footage accumulated. 11,260 hours of video. The investigators would sit in shifts, fast-forwarding through the recordings, tallying every transaction they could identify. The receipts accumulated 25,843 individual purchase records, pulled from trash cans and solicited from customers willing to share. Each receipt was photographed, cataloged, and cross-referenced against what Luckin claimed to have sold in that location on that day. The gaps were undeniable. Luckin's internal data, which the company shared with investors, showed stores selling hundreds of items per day. The surveillance footage showed dozens. The receipts showed dozens. The receipts showed dozens. The discrepancy wasn't subtle. It wasn't a rounding error. It was systematic, consistent, and catastrophic. In January 2020, an anonymous 89-page report began circulating on Wall Street. The author was never officially identified, but the research came from Snow Lake Capital. They handed it to Muddy Waters Research, a prominent short-selling firm with a history of exposing Chinese frauds. On January 31, 2020, Muddy Waters tweeted that they were shorting Luckin coffee and attached the report. The market's initial reaction was confusion. The report was dense, technical, and based on methodology that seemed almost absurd. You hired 1,000 people to sit in coffee shops and count cups. Luckin issued a furious denial. The allegations were false and malicious. The company's fundamentals were strong. The stock dropped 20%, then recovered over the following weeks as investors decided the accusations were too outlandish to take seriously. Inside Luckin, panic was setting in. Charles Liu knew the report was accurate. He knew because he had orchestrated the fraud himself. In the weeks following the Muddy Waters tweet, executives at Luckin did something that would later become a key piece of evidence against them. They purchased an unusually comprehensive directors' and officers' liability insurance policy. D&O Insurance protects executives from personal financial liability in the event of lawsuits. The policy Luckin bought included specific coverage for securities fraud claims. They were buying fire insurance while holding the matches. The auditors at Ernst & Young were already suspicious. The anonymous report had given them a roadmap. They started asking questions about the bulk voucher purchases. Who were these corporate clients buying hundreds of thousands of vouchers at a time? Why were their payments routed through such convoluted channels? Could Luckin provide documentation proving these were legitimate transactions? Luckin's finance team scrambled to produce paperwork. The paperwork didn't hold up. EY's forensic accountants began tracing IP addresses associated with the voucher purchases. They led back to companies that, on closer inspection, were controlled by people in Charles Liu's orbit. The corporate clients buying all those vouchers were shells. The revenue was fake. The entire financial picture was a fabrication. In late March 2020, Ernst & Young informed Luckin's board that they could not sign off on the company's annual report. The auditors had found evidence of material fraud. A special committee was formed. Emergency board meetings were held. And on the night of April 1, 2020, the wall of silence broke. The filing went live on the SEC's website at 9 a.m. Eastern Time on April 2, 2020. Form 6K. Foreign Company Disclosure. The relevant paragraph was clinical in its devastation. The chief operating officer, Qian Liu, along with several employees reporting to him, had engaged in certain misconduct, including fabricating transactions. The aggregate sales amount associated with the fabricated transactions amounted to approximately RMB 2.2 billion, approximately $310 million. When the market opened 30 minutes later, the selling was instantaneous. Algorithms detected the 6K filing and began executing sell orders before human traders had finished reading the first sentence. The stock opened at $26. Within minutes, it was at 10. Then 5. The circuit breakers tripped repeatedly, halting trading for brief intervals that only prolonged the agony. By 10 a.m., Nasdaq suspended trading entirely, pending further news. The ticker froze at $4.39. Luckin had lost 80% of its value in 45 minutes. $5 billion had evaporated. The aftermath was chaos. Chinese regulators, embarrassed by a scandal that had played out on American exchanges, launched their own investigations. The SEC began enforcement proceedings. Class action lawsuits materialized within days, filed by shareholders who had lost fortunes on what they thought was a legitimate investment. Qian Liu, the COO, was arrested and would later plead guilty to charges related to the fraud. Qian, the CEO and Charles Liu's longtime lieutenant, was fired. The company delisted from Nasdaq in June 2020. But here's where the story takes its strangest turn. Luckin Coffee did not die. The product was real. The stores were real. The app worked. The coffee tasted fine. Millions of Chinese consumers have become habituated to ordering Luckin through their phones, picking up cheap lattes on their way to work. When the fraud was exposed, they didn't stop drinking coffee. They kept ordering. The company entered a restructuring process, paid a $180 million settlement to the SEC, purged its leadership, and emerged from bankruptcy as a private company with new management and a much more modest valuation. And then something remarkable happened. Luckin started growing again, not through fraud this time, through actual sales to actual customers. The blitzscale playbook had worked in a perverse way. The subsidized coffee and aggressive expansion had built genuine brand recognition. The new management inherited a nationwide network of stores and an app with millions of active users. They raised prices, cut costs, and focused on profitability instead of growth at any cost. By 2023, Luckin Coffee had more stores in China than Starbucks. Over 10,000 locations, they had become the largest coffee chain in the country they set out to conquer. The fraud had destroyed the company's stock price and wiped out its American investors. But the underlying business, built on the ashes of a $12 billion lie, was thriving. Charles Liu was never charged with a crime. He resigned from Luckin's board in July 2020, but faced no prosecution in China and was beyond the reach of American authorities. His personal fortune, accumulated through the Car Inc. exit and various other ventures, remained largely intact, and in 2022 he started a new company. It's called Cotti Coffee. The playbook should sound familiar. Aggressive expansion, deep discounts, mobile ordering, rapid store openings. By early 2024, Cotti had opened over 6,000 locations in China. The prices are even lower than Luckin's were during the fraud years. The subsidies are even more extreme. Charles Liu is doing it again. Qian, the CEO who was fired in disgrace, joined him at Cotti. The team that orchestrated the largest corporate fraud in Chinese history is running the same play, in the same market, with the same tactics. There is no evidence of fraud at Cotti. The company claims its financials are legitimate, but the investors pouring money into this new venture are betting that the man who faked $310 million in coffee sales has suddenly developed a conscience. The short sellers who exposed Luckin made fortunes. Muddy Waters and Snow Lake Capital profited enormously from their positions when the stock collapsed. The 1,400 part-time investigators who sat in coffee shops for months, filming counters and collecting receipts, probably received modest hourly wages and no share of the profits. They were the foot soldiers in a financial war fought between hedge funds and fraudsters, and their reward was a paycheck and anonymity. The insurance companies that sold Luckin's executives their D&O policy sued to void the coverage, arguing that you cannot purchase insurance for a disaster you're actively planning. The litigation dragged on for years. The courts eventually sided with the insurers. The executives' coverage was rescinded. Whatever personal assets Jiang Liu had in the United States were exposed to civil judgments. American regulators, humiliated by their inability to detect or prevent the fraud, pushed through new legislation. The Holding Foreign Companies Accountable Act, signed into law in December 2020, requires foreign companies listed on U.S. exchanges to submit to audits by the Public Company Accounting Oversight Board. Companies that refuse face delisting. The law was aimed squarely at China, where regulators had historically blocked American oversight of Chinese firms' financial records. Hundreds of Chinese companies now face the threat of losing access to American capital markets if they cannot prove their books are real, but enforcement remains inconsistent. The SEC is understaffed and overwhelmed. Chinese companies can still raise billions on American exchanges with minimal scrutiny. The fundamental asymmetry that allowed Luckin to flourish, American investors funding Chinese companies that American regulators cannot inspect, persists. The coffee machines are still humming. The orders are still coming in. The orders are still coming in. The app still works. In cities across China, millions of people start their mornings with a cup of Luckin coffee, ordered through their phones, picked up from kiosks on street corners and in office building lobbies. They don't think about the fraud. Most of them never knew it happened. They just know the coffee is cheap and the pickup is fast. Charles Liu understood something fundamental about markets. The narrative matters more than the numbers. If you can tell a compelling enough story, investors will suspend their disbelief. They'll see growth where there's only spending. They'll see value where there's only velocity. They'll hand you billions of dollars to chase a dream that exists only in PowerPoint presentations and fabricated financial statements. The story he told was about defeating Starbucks. The story that actually unfolded was about defeating the people who believed him. The investors who bought Luckin stock at its peak lost almost everything. The institutions that provided capital lost billions. The auditors who signed off on fraudulent statements lost credibility. The regulators who failed to catch the scheme lost face. The only person who won was the man who set the fire. He walked away rich. He started over. And right now, somewhere in China, a customer is pulling ticket number 127, wondering why the store seems so empty when the numbers are so high. 11,260 hours of video footage sits on hard drives somewhere, a monument to the absurd lengths required to prove what everyone should have suspected from the beginning. The fastest company in history to go public was also the fastest to reveal what happens when growth becomes more important than truth. And McCoffey? The coffee was always real. That's the part that makes this story so unsettling. They could have built something legitimate. They had the technology, the logistics, the brand, the market. They chose to fake it anyway, not because they had to, because it was faster, because the blitzscale playbook demanded numbers that reality couldn't provide, because Charles Liu had done it before and gotten away with it. The ticker LK doesn't exist anymore. The stock delisted, the lawsuit settled, the executives scattered. But the stores remain, the app remains, the customers remain. And somewhere in Hong Kong, a team of analysts is probably already counting cups at Cotti Coffee, waiting to see if history repeats itself. In the end, Luckin Coffee wasn't a coffee company that committed fraud. It was a fraud that happened to sell coffee. The distinction matters. The product was incidental. The scheme was the point. And the scheme, stripped of its consequences, worked exactly as designed. $12 billion in value, destroyed in 399 days. $310 million in fabricated sales. 80% of stock value lost in 45 minutes. 18 months from founding to IPO. 1,400 investigators counting cups. 25,000 receipts pulled from garbage cans. One man who walked away free. One new company doing the same thing. The numbers are the story. They always were. Charles Liu just counted on no one checking them.